Alright, I'm Ben Coin, Chess and Wine here. The video that I did last evening on Friday, October 1st, 2010, sought to more or less recap the broad state of the current stock market, where I discussed the idea that we are more or less seeing a correction in time more than in price. And we're seeing more and more signs of a healthy market than we saw throughout the summer, because money was coming out of the more extended leaders, such as in the technology sector, and it was rotating over to some of the laggards, such as in the energy sector and the steel sector, and even some of the financials. So I think that's more of a sign of a healthy market than what we saw throughout the summer, where we would have alternative periods of risk on and risk off, where everything would go up and then everything would roll over and go down. So my point of this video is to show you how each individual trade that I make, I look at it as a piece within the broad puzzle of my portfolio, and I encourage you to do the same thing. As an example, in this video I'm going to focus on my thinking behind a position that I took on Friday, which surprised many of my readers. I went long the DZZ, which is an ultra short gold ETF, so it's double the inverse of the performance of gold. Now, here's my thinking behind that trade. If you've been following my blog over at ibencoin.com, you know that I'm net long. I have plenty of longs in my portfolio. However, for roughly the past 2 weeks, I've had a hedge in my portfolio, which was the long QID position, which is the ultra short QQQQ ETF, which is basically just me going double short the technology sector, and I did it as an insurance policy right around here at this point in time. And you're looking at a daily chart of the NASDAQ here, because technology had such a parabolic move off of the bottom here in late August. Now, my thinking was that I wanted to take that hedge out as an insurance policy in case we did roll over again like we did throughout the summer. At that point, I wasn't completely convinced that we had that this trading range, this tight trading range, wasn't going to continue. So here we are 2 full weeks later, and you can see the NASDAQ has had a correction, much more so in time than in price. Again, that's one of my themes of the broad market here. So my thinking going into next week is I'm looking to lighten up on that QID hedge, if not take it off completely, because I'm not so sure that I have a favorable risk reward anymore to carry that hedge in my portfolio. Now, if I do that, unless we come in on Monday and the market completely rolls over, in which case I'll most likely keep the hedge for a while to capitalize on more downside. But if that doesn't happen, I'm looking to take it off, and then I'll be completely long with no shorts. So my thinking was I wanted to have a play in my portfolio where I had a potential to capitalize, even if stocks continue to go up. And what I mean by that is this: here's a daily chart of the GLD for gold, and it's pretty extended here. You can see the angle of ascent is very steep, but that in and of itself is not a reason for me just to short it per se. However, I want to make a comparison between the current market now and the market that we saw in 2004. Remember, 2002 was the big crash year down, just like 2008 was. 2003 was the big recovery year, just like 2009 was. And 2004 was essentially a flat, dead kind of year, just like 2010 more or less is shaping up to be net. So what interesting thing that happened in 2004 was many of the correlations that we've become accustomed to: dollar down, gold up, stocks up, or conversely, strong dollar, weak stocks, risk off. In 2004, many of those correlations began to detach, even if it was momentarily, and those correlations eventually came back later on in the decade. Now, my bet simply is this right here. I think, with me on the verge of taking off my ultra short technology bet, gold could actually fall here. As you see, it's very extended, but that doesn't necessarily mean that the stock market is going to fall as well, because like I said, the stock market is looking healthier than it was at any point throughout the summer. So stocks could go up and my longs would benefit, but gold could go down, and then I would really benefit with my ultra short gold. And even if stocks go down along with gold, then I still have this as a hedge, the short DZZ. So the only way I lose is if the stocks go down and gold goes